Today we are going to talk about different types of risk which an investor faces. Systematic risk refers to the risk which is inherent to the entire market or market segment. It is also known as undiversifiable risk. It affects the overall market and not just a particular industry. This type of risk is very unpredictable and pretty much impossible to avoid. But investors can somewhat mitigate the impact of the systematic risk by diversifying their portfolio. Unsystematic risk is a risk that is unique to a specific company or industry. This may include strikes, outcomes of legal proceedings, or risks that occur due to natural disasters. The latest example which we can relate for the unsystematic risk is the collapse of the US hedge fund Archegos Capital, which costed Credit Suisse nearly $4.7 billion. Operational risk can also be classified as a variety of unsystematic risk and is pretty unique to a specific company or industry. This risk which shows a change in interest rate and the change it can bring in the value of an investment. We all know that the relationship between bonds and interest rates is inverse most of the times. And if interest rate rise, the value of a bond or other fixed income investments will decline. So interest rate risk can be reduced by holding bonds of different durations or just by hedging fixed income investments, options, or interest rate derivatives. These are the risks associated with a trading that include slippage risk, poor execution, gap. Slippage risk involves basically hidden cost associated with every transaction. Poor execution occurs when the trader or the broker encounters problems in making the trade or the investment. Volatility risk is the speed of movement in the price of an asset. A higher level of volatility indicates larger moves and wider changes in the value of an asset. Gapping is a risk that arises due to market volatility, causing prices of financial instruments to suddenly shift from one level to another without passing through the level in between. Now, this generally relates to losing money while investing. Credit risk, liquidity risk, asset-backed risk, foreign investment risk, equity risk, currencies, these are very common forms of financial risk. Now, let's take an example. 2007 to 2008, the global financial crisis which happened when a critical sector of the market completely struggled and it impacted the monetary well-being of the entire marketplace. Now, let's not forget, during this time, businesses were closed, investors lost fortunes, and governments were forced to rethink their monetary policy. So what do we know and what did we learn? We know how many kinds of risks are involved in an investment. And what did we learn? That we need to have proper risk management for our investments. Talk to your consultants, talk to your experts, and protect your portfolio against any of these risks described. My name is Yogesh. Once again, thank you so much.